Hey, good morning, everybody. My name is Garland Benton. I am the Director of Business Development at Direct Equity Source out of Austin, Texas. And I've got the pleasure this morning of sitting down with Andrew Frauenlein, who's the Director of Investor Relations and the President of AAA Storage, which is Paul Bennett, joining me this morning.
Garland, super happy to be here, and man, we really appreciate our relationship with DES and the opportunity to work with you and Joel and the whole team, and the opportunity to get a little visit in today. We don't get to we're so both so busy we don't get to stop and chat like this that often. So I'm really glad to be here today. And Andrew's with us because you and I are old guys, and the technology sometimes stumps us. So we got Andrew here to help make sure the recording goes well.
Yeah, absolutely. I appreciate all your help, Andrew.
Well,
All
great. Well,
right.
you had some questions for me, Garland. Let's go at it.
Yeah, Paul. First off, just a little intro and how we kind of blend with you guys and the relationship. Direct Equity Source has made a pretty sizable commitment to you guys over the last few years. I think we're in about 22, 23 developments with you guys to date.
Yep.
We've been extremely pleased with the transparency of your company, just everything you guys have finished. The communication has really been top notch, thanks to you and Andrew. Always responsive if we have questions. But I just really wanted my investors. They always hear my point of view, but I'd love the opportunity for them to hear directly from you guys, kind of your vantage point of being on the inside there on what sets AAA apart. And you guys have done this, let's see, 32, 33 years now. So you have a very specific model. So yeah, I just love to get your direct insight to share with some of our investors on kind of why AAA works the way it does and it's been so successful.
Yeah, well, thanks, Garland. Yeah, we've been very blessed, to be frank. We have been at this 33 years. We've got 90 full cycle investments. That's properties that we've developed, stabilized, and sold over those 33 years. And our average return to our investors is right at a 20% internal rate of return. That's a time valued rate of return. So we've had a lot of success in just about every kind of real estate market you can imagine over the last 33 years. Everything from the Great Recession in 2008 or the dot-com bubble in the late 90s, up through the most recent period, including COVID. So we're pretty proud of that track record and thankful for partners like you guys. We've worked together for a good while, and that's been a real blessing to us as well.
Yeah, absolutely. I guess we could talk all day about the ins and out of the business, but I'd really like to just kind of, I know your time's very valuable, streamlining into what are my investors typically asking? What are the questions that come to mind that I get over and over, so we just can kind of address some of those. I think the first thing that stands out is AAA has got a very specific model that you guys choose to do new construction versus a lot of companies you see out there are always doing value add, buying older properties, going to inject capital and trying to turn it around and fix them up. What drives AAA to only focus on the new construction frontier, I guess is it.
Yeah, we have done some value add, Garland, but not in the sense of buying an underperforming asset and then trying to pretty it up. When we do value add, it's because we can buy an existing facility that has excess land and we can add to it, which is sort of our version in the construction world of value add. I think first of all, I think a good portfolio for a real estate investor includes some existing property and maybe some value add, some core plus and some value add and development. I think it's a mistake to leave development out of the mix as an investor, as you build your portfolio over time. One of the reasons that we think new construction is so important is because of the value creation that occurs when you build a new facility. There's a real difference in what it costs to build a facility and what the cash flow that facility generates once it's stabilized is worth in the marketplace. And that value spread provides a real buffer when you hit sort of unexpected turns in the market. I'll give you an example. The self-storage industry has had a great run for a very long time. Coming out of COVID, it was on fire. I mean, occupancy nationwide was at about 98%. Um, and at the same time, interest rates were 2.5%. And that combination caused a lot of new development. We had about a 3-year period in the storage world from 21 to 24 where if you bought an existing facility, it's very likely it wasn't worth in 2025 what you paid for it in 2021 or 22 because rates had gone down. There had been some pressure on occupancy because of some oversupply in the market. And those people that made those investments are going to turn out fine if they just hold the property long enough because rates are starting to increase. The market's really turned. We've seen a real bottom in the market. Cap rates have compressed. We're seeing deals go off at 5.5 caps today. But if you bought in 22 or 23, you're probably struggling. We developed in 22 and 23, and because of the additional value that we can create by developing versus buying existing, we've seen returns stay fairly stable for the projects we've exited. And so and we can talk about more about that if you want to, the whole concept of yield on cost and how that drives value in real estate development. But the reason is that there's added upside potential in development, and we think that's a very important aspect of what we do.
Yeah, no, absolutely. Uh, yeah, that's a great outlook. Some good key points. I think one of the main, I do a lot of due diligence. Actually, have been in private equity for now over 20 years, coming on 25 years. And I think it really all goes back to the due diligence when you get into a project. And so one thing I'm constantly looking at when I'm evaluating deals that I invest in myself personally or sponsoring comes down to how the sponsor aligns themselves with the investor. And by that, I think one of the most important keys is how much capital are they actually committing alongside the investor. Through the doing this again over 20 years, I look at whether it's multifamily, oil and gas, single family, RV parks, storage. It really all comes down to the same. I think what you see out there is sponsors that put up, just a couple percent, sometimes as little as 1%, maybe if you're fortunate up to maybe 5% of the money is kind of industry typical, I guess you could say. And that's one of the things that attracts us to AAA. Correct me if I'm wrong on this, but aren't you guys putting in about what works out to be 20 to 25% of the capital on each one of these deals that you guys are doing?
Yeah, Garland. Other than our track record, which we are proud of, we're humbled by it, but we're proud of. I think the other thing that I'm most proud of is that we're really more of a real estate investor than we are a sponsor. We've been the largest single investor in every investment we've ever sponsored since 1993. Um, in the current investments that we're making, we write into the prospectus that we will be a minimum of 8%. The last two investments that we launched and sponsored, we were 21%, and the current fund is we are at about 22.5% of the total capital. Today, we're actually more than that, but if we raise the 45 million, 46 million that we intend, we have a $10 million commitment. Let me just put it that way, put it in dollars. Um, and that's real money that's right alongside the investors under the same terms with no difference. The only thing we do is we don't pay the management fee because there's no sense in paying ourselves. We move it from one pocket to the other, but all the other terms are the same. Um, and we do think it creates alignment. And when you combine that with the fact that we personally guarantee all of the construction debt, which today in the investments that you're in is well over $100 million worth of construction debt, it absolutely creates alignment And I'm sort of an old country boy. I tell you, you don't want to do business with somebody that doesn't eat their own cooking. And we eat our own cooking because we love what we're doing. We believe in it, and that's why we're willing to commit the kind of capital that we do.
Yeah, I mean, I think that again, of all the due diligence, I think that stands out. I mean, you've been in the investment world a long time. I mean, that's definitely rare, to see somebody putting up that much of their own capital into the deal. And again, it makes you feel good at the end of the day that they're right there alongside you because a lot of these companies, the way they're structured, they're going to make money regardless of the outcome. So, love the amount of capital you guys are putting into every deal. That really stands out to myself and my investors.
Yeah. Our philosophy is we'd be doing this anyway. When we have partners like DES and your investors, it just allows us to do more than we could have done on our own. And that's really the why we're as much of an investor as we are a developer or a sponsor from that standpoint. So.
Yeah, that's great. So I think another question that comes up with investors all the time is you look at the cost to construct. I know you talked about it a little bit
Yeah.
earlier, getting in at a base is cheaper than you can buy. But, I'd like for you to be able to share with some of our investors. They always think, well, that's too good to be true. There's just no way that you can make a two and a half, three and a half, to one return on your investment constructing a new property and sell it. So, if you don't mind, love to have you walk us through your, yield on cost and value creation on how those numbers actually work, where you can legitimately see those type returns on your properties.
Yeah, and that really kind of goes back to the first question we discussed, which is why construction and development versus buying existing or doing value add. Um, I've got a slide, but rather than, I think I can talk through it as well as we can put a slide up there. There are two concepts in development that, if you're not aware of, would be helpful to understand. One is called yield on cost, and yield on cost is simply the pro forma, the projected stabilized net operating income of a property expressed as a yield on the actual cost to construct that property. Um, and the second concept is development spread, which is the difference between yield on cost and cap rates in the market today. So in today's market, we're underwriting to a 9.5% yield on cost. Um, and today's cap rates in the market are 5.5. That means we have a 4% or 400 basis point spread between what we're getting as a yield on our cost to construct and how the market will value that property when it's stabilized. I'll give you an example. We use round numbers. If we can build a property for $10 million at a 9.5% yield on cost, that means its net operating income is going to be $950,000 when it's stabilized. We build a property, we get it leased up. That process takes about 3.5 to 4 years. And when we go to sell it, it sells at a 6 cap, which is a very conservative cap rate in today's market. That property, the cash flow stream from that property, based on the cap rates in the marketplace, is worth just under $16 million. So we build it for 10, and at the end of the day, it's worth 16. But we only put about 30% of the cost in as equity on a deal. Our loans are probably typically 70% loan to cost. So that means on that $10 million project, we had a $3 million equity check. We sold it for 16. We pay off the $7 million of debt. We've got 9 million left, and we put 3 million in. So that's where you get to those 3-to-1 returns. And when we do that over a 4-year period, 4.5-year period, it automatically results in an IRR in the low to mid 20% range. And that's the play we run over and over and over again. And particularly when you're diversified through a number of projects like you are at DES and we are here, some that is not the perfect, it's not the outlier, but it's the average. That means there's some projects that perform better than that, and others that perform a little bit less than that. Maybe they take a little bit longer, to mature, so the time valued returns are a little bit lower. But when you have diversification and that's sort of your median, that's what you get as a result through a diversified portfolio when you're developing.
Yeah, I mean, I think that's a perfect explanation, and which really kind of led me into my next question. Goes around on that line. I think again, when you look at your competitors out there, how are they forming their syndications? What I see in the marketplace is a lot of syndications, and I know way back in the day, AAA used to do single properties at a time because we did those with you. And now you guys have evolved over to, what I would consider like a fund format, multiple properties instead of doing one-off syndications. So, what's your internal, thought there on why does a fund make more sense to an investor? And why did you guys go to that model versus doing one at a time, one after another?
Yeah, there were a couple of reasons. Number one, it's all about diversification. If you're invested in, if you look at our track record over 90 deals over 33 years, if you just invested in one of those deals, you might have invested in the deal that provided a 35% IRR, and you might have invested in the deal that created a 14% IRR, because we have both of them in our track record. But if you'd invested in every deal we ever did, your returns would be number seven on the list of the most successful investors in all of United States history. And Warren Buffett would be number eight. That's the power of spreading it across. And maybe that's not well said, but it's really about diversification, and not betting on one horse, but having, in our portfolios, there absolutely one project will outperform another. But what you're looking for is a mean that gets you that above average, risk adjusted, low 20% IRR type of return. And that's what we've been able to produce consistently with the diversity. And then the other thing it gives you is it gives you diversification through markets. So it's not just having multiple opportunities, but it's being in different markets. It's with one investment being in Houston, San Antonio, Austin, and Charlotte, North Carolina. Um, just for an example. And then for us, quite frankly, it's a little bit more efficient than raising capital one project at a time. But the real driver is for our investors, and that's for diversification, both across multiple properties and markets, as well as property types, and having more than one opportunity to generate that return that they're looking for.
Yeah, I mean, I couldn't agree more. When I look back on all the, investments that I've made myself through the years, again, I mentioned earlier, I've done everything from RV parks to storage to multifamily, and I think when you look at oil and gas, when you look at what worked the most, it was where I had multiple properties and diversification because, as you said, some don't always perform as you anticipate. Some are going to outperform what you ever expected. So, being in a mix, I would much rather make one capital commitment and be in multiple properties as opposed to, having to invest 5 to 7 times over to achieve that, that exposure. So yeah, just streamlines it from everything from accounting to paperwork and really streamlines the entire process, I think.
Yeah, no, I totally agree. And you guys at DES have done a great job of creating diversification for your investors, the
Sure.
approach that you've taken and the way you've done it. So,
Yeah, absolutely. One thing I get asked all the time, because I personally live up closer to the Dallas market, and what you see popping up everywhere are these, massive, 3, 4 story, cube smarts of the world and the public storages of the world, big multi-level facilities. You guys have a very specific model that you build. It's to me, it's almost like cookie cutter one to the next, right? Just different location. Um, Explain to some of our investors. I always get asked, well, why aren't you guys doing the multi-stories? Why are you guys not doing these big, complexes as opposed to, what AAA typically builds? So what's your, I know you've got some pretty specific cost breakdown, but maybe you'd explain the reason you guys build that single story on the cost versus what they're building at that multi-story facility.
Yeah, that's a great question. I love it. So the first reason is financial and pragmatic. We talked about yield on cost a minute ago, and that is the relationship between what it costs to build a project and the yield that it provides, or the net operating income expressed as a yield on that cost. Um, we build at around 100 to $105 a square foot in the single story drive up product that we build every day. The guys that are building the multi-story boxes are they have about $160 a square foot in that real estate. We don't have to have sprinklers. We don't have to have elevators. Our buildings are slab on grade metal buildings. Their buildings have, brick fascia on them or stone or whatever. It's just simply a more expensive product to build. And at the end of the day, the rent premium they get is really minimal. We compete with them every day, and they're not going to be able to get a significantly more rent than we are. So at the end of the day, their NOIs are equivalent to ours on a square foot basis, and their cost to build is about 50% more. So their yield on cost, where ours is 9.5, their yield on cost is in the 8.5 range. And that limits the amount of value creation in the development process. And so that's really the reason why we have stayed with the single story drive up product. The other two things are the multi-story box makes a lot of sense if you're in Metro, Fort Worth, or Dallas, where land's $1.5 million an acre, because you can build a 50,000 square foot facility on an acre and a quarter. Obviously, our projects take a little more space. That means we're focused on what we call the city skirt markets. We're building in Arcola outside Houston. We're building in Georgetown outside Austin. We're building in Buda south of Austin. So we're building in the bedroom communities that are supported by these big metros, versus building, truly urban self-storage facilities. The other reason is more consumer oriented. I'm going to ask you a question. Would you rather back up to your unit, open the door, and roll the sofa into your unit? Or would you rather pull up, go get a cart, bring the cart out, put the sofa on the cart, figure out how to jam it in the elevator, go up 3 floors, get it caught on the elevator door trying to get out, wheel it down the hall, and then finally get to your unit and take it off the gurney and put it in the unit? Which one makes more sense?
I've actually had to do both, only because I didn't have a choice, but it is a definite learning lesson. The multi-story, even though they look pretty, on the outside aesthetically, it is a nightmare going up multi levels on the elevator. Even though
And,
you're not dealing with stairs, just the elevator and the hallways are an absolute nightmare. So I
and, I mean, I can tell you for a fact that they're renting their first floor units for more than they're able to rent their third floor units because of convenience. So at the end of the day, the drive up product is better for the consumer, and it's better financially for our investors. So that's really why we've stuck with it.
yeah, I mean, with 50 to 60% less cost, what do you think the rent premium is they're even getting on the multi-story,
Anywhere
versus
from maybe 8 to 15%.
so they're spending 50% more to get 8 to 15% added cash flow. Yeah, the numbers don't make out in my book anyway.
Yeah, no, that's, I mean, the true reason is the numbers don't make sense to us, and we are investors ourselves, and so but there is a convenience factor. In fact, I've got our marketing team. We're going to have some fun in 2026. We're going to do some marketing where we sort of make fun of the inconvenience of multi-story properties, and we compete with them every day. They're all around all of our facilities, so we're going to have some fun with that. So.
Sure. No, absolutely. Another thing, I know we spent a lot of this conversation most conversations with clients about the climate control storage, part of the equation. But something we really haven't talked about that I am a huge believer in, I've seen it firsthand. I actually drove down to our Georgetown location here just
Yeah.
2 weeks ago, did an investor tour down there, had some guys come in. Absolutely was blown away how that thing has come together. Just, I was there in the fall and then just went back 2 weeks ago. And in just 90 days, it just seems night and day how that thing's come together. But where I was going with that is talk a little bit about the other component of this project, that's the small bay industrial.
Yeah.
Again, we focus a lot on storage, but I don't think the small bay gets near enough attention. Tell us your thoughts on blending those both together in one fund. And then the second part of that question is, what are you seeing out there, occupancy and demand in small bay?
So, for people who may not know, small bay industrial, also known as office industrial flex, is a unique sort of segment of the market in the industrial category. It's essentially a 5,000 square foot bay that's got 1,500 square feet of office in the front and 3,500 square feet of warehouse in the back with a roll up door. And we build a 20,000 square foot building and we subdivide it based on the tenant space needs. And the kind of tenants you find there are home service businesses, last mile logistics companies, internet-based businesses. Um, and we've seen some real interesting trends with consumer-oriented businesses out in Georgetown, where you visited. We have a 20,000 square foot building that was all leased by a pickleball provider who's got a private pickleball club. In that same facility, we've got a gymnastics uh, training facility, excuse me, and infinite hitting, a baseball training facility. So we've seen some consumer uses evolve recently, but the small bay product is probably the hottest sector in the real estate industry today. Nationwide, average occupancy is about 97%. The demand continues to grow because the new users that are emerging, like the consumer users I was talking about, the last mile logistics users, the internet-based businesses, and you've got constrained supply. It's a product that the traditional industrial developer doesn't want to build because he wants to go build 1.5 million square foot warehouse for Amazon or a warehouse for Walmart or somebody like that. It's more efficient for him. So this sector of the market is sort of fragmented and it creates a real opportunity for us as a developer. The other things that make it interesting, I told you a few minutes ago that we developed to a 9.5% yield on cost in the self storage arena. In small bay, we developed to a 10.5% yield on cost, which means that $10 million project would have 1,050,000, not $950,000 of 1,500,000, excuse me, of net operating income, not 950. So there's a lot of value creation in the small bay space. The Georgetown project that you visited was 70% leased before we ever finished it, just as an example of the kind of demand that exists in the market. And I don't care where you're listening to this recording, I would challenge you to go out and try to find a 4,000 square foot small bay space to rent in your market, in your hometown. There's probably a 7 out of 10 chance you can't find one. And the other things, I'm going a little bit long here, but different than storage, the buildings are very similar. They're slab on grade, metal buildings with a 25 or 30 foot clear span ceiling, because these are industrial users. They need that additional height. But the construction's very similar. I mean, they're again slab on grade metal buildings, just like a storage facility. Um, and so they're very simple to build. And the other difference, or the difference with self storage, is in self storage we basically have a month to month rental agreement. In the small bay product, we have 3 to 5 year leases that have an annual escalation clause in the lease, and they're triple net, which means each tenant pays their pro rata share of property taxes, property insurance, and common area maintenance, which insulates the investor from potential cost increases because property taxes went up or property insurance went up, both of which have happened in the last few years. So it's a great investment with a little bit more stable income stream than self storage. And what we're able to do is buy a larger tract of land, divide it into two, and build self-storage on one part and office industrial flex or small bay on the other, which gives us some cost efficiencies in development in terms of utilities and infrastructure and that type of thing. So it's been a great product. Our funds are typically allocated 60% to storage and 40% to small bay, and we're having so much success in the small bay that I'm not sure that our next fund won't be more equally balanced or even inverted and be 60% small bay and 40% storage. So
Yeah, no, that's great information, and I think you kind of touched on a lot of investors out there that are new to storage. The first thing that they think is, oh, it's overbuilt, it's oversaturated. I missed the boat. It's too late. I mean, I think the occupancy numbers that we've seen firsthand on all the properties that we built would be a strong argument against that. Again, you're not going to have 95, 97% occupancy across the board if it's an oversaturated market.
yeah, the storage market is interesting. There was a time when you could throw a dart at a map and wherever it landed, build a self-storage facility and be just fine. Today, you have to be a little bit more thoughtful, a little bit more strategic. We do extensive, the last 11 property portfolio that we put together, the market data and all of the due diligence that we did on each of the market. What is the supply? What is the demand? What new facilities are planned in that market? A total about 142 pages of data. So we look at each market in real detail to make sure that we've got the best balance between supply and demand possible to drive success in the project, over time. And I'll wander here a little bit, but if any of your investors have done multifamily in the past and that's sort of how they orient, even if you get caught in a market where there's more supply than would be desirable, the fundamental difference, particularly with multifamily, is that our carrying cost, because we're building at $100 a square foot, is far less. If we miss the lease up projections by a year, it doesn't help returns. It certainly impacts them. It doesn't destroy them. In a multifamily project where you're building at $280 a square foot, if you miss your lease up projections by a year, the bank's probably taking the property back. Or you're having to pour so much cash in it to keep it afloat that it destroys the returns. And so self-storage it sits in a unique place in terms of its ability to absorb risk, in markets that kind of go in directions you didn't anticipate.
Yeah, no, I think that's a great point there. Well, Paul, I won't hold you. I know you got a lot of things going on and your plate's pretty full, but I really appreciate you taking the time to kind of share with our investors some of your insight knowledge and what's going on over there at AAA. Like I said, we've been very, very pleased with our experience with you guys, from the transparency to the communication and projects being delivered on time. I mean, that's a rarity, in the private equity community. So much appreciated, and thank you for sitting down with us today, and look forward to doing business with you guys.
It's been fun, Garland. Like I said at the beginning, we so appreciate the partnership with DES and you and Joel and the whole team, and look forward to a lot more.
Yeah, absolutely. Well, appreciate it, Andrew. Thank you for all your help, and Paul, and we'll talk to you again soon.
Take care, my friend.
All right, take care, bud.